We're moving forward now. We've covered the unadjusted trial balance, and we're going to get into step 4, and we're going to move forward into 3.4 in your chapter, where we deal with adjusting entries. But before I get into 3.4 in your chapter, where we're dealing with adjusting entries, I need you to understand why we are making and creating adjusting entries. Adjusting entries are recorded as transactions, and guess where they are recorded? In the original book of entry. What is that? The General Journal. Adjusting entries are recorded in the General Journal to record adjustments to accounts that have been affected for the period of time that we're reporting on. What do you mean? Remember, most of the statements, except for the statement of financial position on the balance sheet, is a period of time statement. Your income statement is a period of time statement. Your cash flow statement is a period of time statement. Your balance sheet is the only statement that's a point in time. The retained earnings statement, which we talked about, is also a period of time statement. That being said, we have to adjust for the period of time that we're reporting. Because remember, the period of time could be a month, it could be 2 months, it could be 3 months, it could be 6 months, it could be 12 months. So let's say my period of time is from January to June. It's a 6-month period. My income statement needs to reflect 6 months. My statement of retained earnings needs to reflect 6 months. My retained earnings statement needs to reflect 6 months. My balance sheet, however, is only going to be as of June 30th. In order for my balance sheet to be correct, I have to properly match, remember that matching principle that we talked about, I have to properly match expenses to the period. Therefore, in order for me to match those expenses to the period, I have to adjust certain accounts. There are 7 adjusting entries, write it down. 7 adjusting entries that you need to consider to properly adjust for the time. If you do not, then what's going to happen is that your balance sheet and or your income statement will be misstated. That's the last thing we want if we're following and complying with GAAP. A statement that is not accurate. So we have to adjust for the time period that those statements are reflecting. There are 7 adjusting entries, and you and I are going to spend time going through those 7 adjusting entries in just a moment. Take a break.